Hi, good evening from South Africa. This is Lyndon joining you to introduce two great deals to you tonight. New deals on the WealthE Migrate platform, but not a new sponsor, an old sponsor who has been with us for a long time, who has brought many successful deals to the platform. And it's great for us to be able to welcome back tonight Justin Clark from OrbVest's. Firstly, Justin, great to have you back. Thank you for joining us and our investors tonight to tell us about these two deals.
Lyndon, thanks for having me on. Thank you, Lee. And guys, great for giving up your evening and I hope I can make you equally excited about the two deals that we've got on at the moment.
Yeah, brilliant. I know WealthE Migrate's very excited to be having these two deals. We've had a look at the information that you're going to be sharing with us tonight. I think we've got two really good opportunities here for investors. Before we get into the details, let's do our normal and firstly say good, Lee, I believe it's late evening, so it's not good evening your side, it's good night on your side.
Absolutely, it is. Hi, everyone. Lee, Head of Communities here. Thank you for joining us. I'm coming to you from Saudi Arabia, Riyadh, but it's great to be online and once again be in the presence of Justin and his medical deals. They are exciting. So please, you've got your little box where you can put your comments and your questions. I'll be monitoring those throughout the webinar, so please put anything that you want in there and I'll make sure that all the questions do get answered.
Fantastic, thanks Lee. And let's start that right now. So please, wherever you are, please just drop in that chat box or that question box which part of the world you are joining us from. It's always great to know as a global company, it's always great to see our community showing up from different parts of the world. So please do drop into that question box where you are joining us from tonight, just so that we have a sense of who's with us tonight. And Justin, let's get straight to it. Two deals at once, that's something that we haven't had from OrbVest's before. Is it just that both deals came along? How did it work out that we've got two great deals at the same time?
Lyndon, I think we've had this conversation many times over. You know, investors like selection, and that's really important. The more selection, the better. And so the idea is we always had the ambition of getting many, many deals on the platform. And so we managed to find two. I know it's a little ambitious, but I've got a very good feeling about these particular two deals, and I think that we'll close them out very quickly. In fact, I'll tell you later, but we do actually have to close them out by before everyone goes and puts their feet up and goes to the beach. So yeah, we'll get into that a bit later on.
Absolutely brilliant. Now, I know, luckily, this is not a position where someone's going to have to choose, because I think both you and I know many of the investors, diversification is a core central theme that we try work with investors on, about the need to having your eggs in different baskets to make sure that you've actually got the opportunities to really spread your investment potential. So the good news for the investors tonight is, guys, you don't have to choose one or the other. If you like them both, if what Justin has to tell you tonight about both of them works for you, you can split your investment into both of them. Certainly we've always encouraged that at WealthE Migrate to diversify your investment strategy. But tonight is not about investment strategy. Tonight is about these two deals. Justin, before we get into the actual deal themselves, and please, if it's in your presentation, please just stop me and we can go straight into your presentation. But I thought it might be good for many of our new investors, just a bit of the history around OrbVest's, around your deal history, around why medical, because that is certainly where you guys are niched and are really leaders in terms of pioneering that medical space for us on the platform. Do you want to talk about that stuff first, or shall we get straight into your presentation if it covers that?
Well, we don't want death by PowerPoint, so I've got a few slides there, but I'll just brush through those. Obviously, a long history for the new investors that are online, and I see there are a few. We go back a long way, and many of the products that we have done in the past were, in fact, WealthE Migrate deals. And effectively, we divided the company, and we have focused very much from an OrbVest's point of view on being a property company. And so we effectively are a property company. We have an ambition to build up a massive portfolio. We are hyper-focused only on one type of property and only in one region. And I think the reason for that, and I'll get into it a little bit later on when we talk about curatorship and due diligence. Due diligence is a tough thing, guys. It is, you never can be the master of everything, the master of every geography. You have to know your product absolutely inside out. So the first thing, we know that medical is the best and most recession-resistant product that you can have in commercial real estate. I think that is endorsed by the likes of JLL and many other property experts across the US will back that up. So we've decided that that's our focus and nothing else. And the US, obviously, we believe in it because it's a massive economy. It has the biggest investment into the US from everywhere else in the world. And so that is our focus. So absolutely one stream focus. And I guess Lyndon will tell you that Wealth Migrate is about a lot more diversity, different geographies and different products. So that's the difference between the two.
So Justin, you mentioned there the key point, I think, for our investors is recession-proof. I'm going to put you a bit on the spot here. Two things do you think one's king, but even more importantly, why does the medical genre, why is it that you believe is recession-proof? What is it about this particular asset class that really gets you guys excited in the potential? And you know, listen, it's going to happen. If it's not now, it'll be sometime. But I think the medical genre is a great investment asset class irrespective. Why is it that medical, do you think, has that characteristic?
Thanks for the super easy questions, Lyndon. Medical, all right. So the first thing, and it's a pretty obvious answer to the question. Think about it. If you are ill, are you going to say, well, I'm not going to go to the hospital until I'm in a better financial position? No, you'll sell the dog and the cat and the house, and you will absolutely go and get sorted out for what you need. So that's the first thing. The second thing is that traditionally leases are, as you know, in South Africa, commercial leases are pretty much the same as the US, 3 to 5 years. What we do with medical is we extend those leases. And in our last project that we launched, mid-25, we had the average lease was 17.5 years. That's the median lease period. And that means that a recession can come and go, and you can be in the next recession and still be within the lease period. The third thing, obviously, is that tenants don't leave. A commercial tenant can pack up, take their laptops, and go and set up across the road. In the cities that we specialize, there's a thing called a certificate of need, which is super interesting, Lyndon, and I think I'll share it, although it might be a bit premature. But you have to do effectively what's an environmental impact assessment to prove that there is a need for your particular practice in that area. And in our focus cities, we focus on those cities because of the certificate of need. And remember, the certificate of need is locked to the building. So you can't just pack up and take your stuff and move. And the third thing is that, the fourth thing, should I say, is that your cost of installation of a lot of things like surgery centers, pathology, etc., there is a significant cost in actually installing your operation there. So it's not so easy just to pack up and go. I hope that's a quick answer for you.
Brilliant. So Justin, I see there are some of our, Andrew, thanks for the comments that we are not able to see the slides just yet. I think that's just because I hijacked Justin up front by just going straight, not even giving him a chance to load his PowerPoint. But I think, Justin, maybe it's a good time to jump in there. So, you know, I know you do have a presentation for us that actually explains both your history, the medical, I think, in a little bit more detail, as well as these two deals. So please go for it. And to all our investors, please do just what Andrew's done. Please give us comments, give us questions as we're going through this. The whole purpose of these sessions with our sponsors when they bring us new deals is so that you have an opportunity to engage with them and you have an opportunity to ask them the questions that you want to ask about their deals so that you can make informed investment choices. And that's really the purpose tonight. So please do use that question box, even if it's just comments, add to the conversation. I will certainly read out your comments so that you can get the feedback from different people as we go along. Justin, over to you.
Thank you very much, Lyndon. So we have, there's a little delay, there we go. So as I explained, guys, very different. We are a property company and we focus only on the USA and very specifically hyper-focus on medical commercial buildings. Please excuse me if I rush through the presentation. I'm very happy to take questions afterwards, but there's quite a lot of information. Normally we'd be talking about one deal, but now we've got two deals to talk about. So we will fly through, especially the conversation about medical. I'm not going to go to the level of detail that we normally go into. And I think that looking at some of the attendees tonight, a lot of the attendees have heard this all before. So yeah, we'll brush through that, but I'll give you the core points. First thing that we obviously have to do is disclosure. OrbVest's South Africa is a financial services company. We work under the as a juristic rep of Van Wealth, and our registration number is 41690. The reason why I obviously have to explain that is for disclosure purposes. Bear in mind that tonight we are here purely to promote the product. We are not here to sell you anything. Ultimately, you will transact on the WealthMigrate platform, and so we will not have to have a consultant involved with you. So the financial services board does not have jurisdiction, but effectively we are here to present the opportunities only. So basically, what is the differentiator between us and other companies? And I think that from a property point of view, the first thing that you always have to look at is, who are you giving your money to? This team is well known to a lot of you that are online. Henny was originally, together with Scott, the founders of WealthMigrate. He's a fascinating character, very much under the radar. He has a massive portfolio of medical buildings in South Africa. And I think that his interest in the US is that the US and South Africa, as far as medical office buildings, is almost exactly the same, except South Africa is very much a mini-me. So the US has a very much private healthcare system, whereas most of the countries in the world have some sort of government control over the delivery of medical services. So there's a wealth of experience there, and as I say, Henny is the chairman of the company and the investment committee. Michiel, who started off many years ago, before most of us, in IPS, buying houses when he still was the COO of one of the big divisions of Siemens, and is absolutely brilliant at finding and negotiating these deals for us. Lo has all the structuring experience and comes from the MSP group, so significant experience in property. Finally, Martin, and Martin and myself are kind of the newbies to the group. Martin is the Chief Executive Officer, best known for founding Bayport Financial Services, which he exited a few years ago. And Martin has been a massive value to the company. He has moved to the US, and we are building out our infrastructure in the US. Bear in mind, you cannot be a company focused on acquiring and operating US buildings unless you have are operating out of the US. So that is what the purpose of Martin being there is for. Myself, I'm best known, I guess, for my part in private property, but I've also had an obsession with property for most of my life and have been a developer and investor. So apart from the team, there is this business of curated deals. And this is something that has been very fascinating to me, guys, is that you are never 100% on any deal. It doesn't matter if you are Sanlam or if you are Redefine. It's a lot of guesstimation. But what you can do is you can put a lot of processes in place which effectively evaluate those buildings and make sure that when you are taking people's money, that you put it into an asset that is not going to fail. And we have not been good at this in the past, but we are getting a lot better at it. And I'm going to introduce you to the guy at the top with a very firm face. This is Michiel's nemesis. So when we bring deals as a company, we are very enthusiastic about putting the deal onto the platform, but we have to get through this investment committee. And it's tougher than ever, and these guys really, really set us on a run around. And those of you who invested in Medical 13 will remember that they forced us to pull the deal right at the end because they weren't happy. So this is something that's getting an enormous amount of resources from us and an emphasis. And this investment committee is something that we are quite obsessed about, specifically under Henny's leadership. The third thing is that we do not take risk. Again, one of our key differentiators is that we are looking for assets that can firstly preserve your capital. If you are sitting in a third world country like South Africa or India or Brazil, the first thing you want to know is, am I giving my money to someone who's going to look after it first? And then secondly, grow it. So if we are going to make sure that we absolutely look after that money, we need to make sure that that building that we take over is already profitable, is generating cash flow, and can continue to deliver quarterly dividends. So we do not take risk. We are not a developer. We look for properties that are profitable. This is
Justin,
the,
can I jump in?
Absolutely.
Can I jump in here? Because I think you know, these first 3 points you've made are really important for our investors listening with us tonight. You know, many of us we have a passion for real estate. It's a fundamental part of our diversified portfolios. We want to be there. And for many of us, we start getting into real estate where we are the people actually managing the deal. We find a nice residential spot. We think we can get some tenants in and rent it out and do the kind of buy to let model. And then we start thinking bigger and we want to go bigger picture. And at that point, as soon as you're wanting to start partnering on some of these commercial opportunities, it's not so much anymore about our ability to run a project ourselves in real estate. It's about how much do you trust the people that you're going to have to invest in. And I think, Justin, I think you really, you've nailed that piece, because I think for all of us, when we're investing in this kind of real estate venture, you're actually investing not so much in the deal, but you're investing in the partners that you're investing with, and the people who are making the decisions and are able to spot and find the great deals. And you know, at Wealth Migrate, when we look for sponsors, that's what we're looking for. We're looking to see, have we brought on sponsors to our investment community where we believe those sponsors have the ability to make good decisions around, firstly, what deals they bring, and then also how they manage that. So I think it's really worth our investors having a good look at that, taking note of the team that OrbVest's has put together to firstly select, but then also manage both the deals and the partners on the ground. And I think, you know, just for all of our investors, this piece is as fundamental as the actual fundamentals about the deal itself. And we really do encourage you to pay attention to the teams that you're going to make your decisions around. And once again, you know, how better to represent that than performance. So, yeah, I think the slide is a great indication.
Thanks, Lyndon. Yeah, that's an important point. So there is the truth is always in the pudding. It's easy to do a webinar and say we're going to give you the best returns in the world. But what is super important, guys, is the cash on cash. How much cash have you actually delivered back to your investors? And I think this slide shows you right from the beginning of Wealth Migrate, the early deals that were done, Medical 1, 2, 3, etc. And you can see over the years what we have averaged. Average annual return 9.6, running through to 8.65, and obviously after tax that drops a little bit, but that is net. That is the actual cash on cash that has been paid back to investors. And bear in mind that after 5 years, what happens is we offer that building for sale to the market. We are required to do so. That's part of our mandate. And then we sell it. We get a capital gain. And that capital gain is shared with the investors. And that takes your IRR, which is effectively the amount that you earn per year, from the cash amount, which would be the 8 or 9, and it takes it up to 12, up to 18, depending on how well we exit. And I want to warn you about IRRs. Personally, I have a view on IRR. As much as you can anticipate what the market is going to do in the future, nobody can guarantee an IRR. So any IRR that you look at, whether it's from us or any of the other sponsors, just take it with a pinch of salt. It is often generated with best intentions, with all the best data available, but we don't know what the next recession is going to look like. So you know, that's just my warning about IRR. So what is OrbVest's all about? We have over 1 million square foot now under management. We have 22, it's now 25 buildings. And we are going to chug on and build a portfolio of $1 billion in the US, which will make us a major player. And that's all we are 100% focused on. Great thing is, look at that stat at the bottom, 93% is, 94.7% is fully leased. So that's what I say, we only invest in stable assets, and we are trying to get better at that. Not going to spend too much time on this, but this is the history of the buildings. You can see in the beginning with Med 1 and Med 2, they were generally smaller buildings. And as we moved up, we've moved to more trophy assets. And the reason for that is that we're going to sell them after 5 years. The REITs actually love trophy assets, and they will pay a premium for them. I think I'm going to fly through this a little bit guys, the US, we did talk briefly about it. It is still the best investment destination in the world. And we don't only look at the country, we also look at the state and the cities. And that is how we funnel our particular area. Once we have identified a state and a city that we're going to invest in, we find someone and then we try and get them to partner with us on a deal. And this is really where, you know, the hard work comes in. You cannot, as a bunch of foreigners, move into a country and expect to know everything about how to do deals there. And that is why there is this importance between you, the investor, us, the administrator, and the partner who ultimately signs and takes the risk of the debt. So, so that's how we go about making these investments. The other thing that's very critical is the
Sorry, maybe you can just explain that. I think it's a key part of your business model, which I think is really important, because I think it demonstrates that your partners on the ground are aligned in terms of the actual deal itself. But when you say it's a partner on the ground that signs for the debt, what does that mean?
Good question, Lyndon. Yes, so effectively, part of the structuring of the loan is this thing called the senior debt, and somebody has to stand surety and put up a balance sheet to get that senior debt. And so we have these people that we partner with. It doesn't stop there. Not only do they sign for the senior debt, but we also require them to put in at least some skin in the game. And then the final thing is that we find partners that have experience in medical and that have the ability in that particular market, if we're talking about Atlanta, for example, that they can fast tenant up any vacancy that comes about. So we're looking for networked operators that have done this before in the medical space. And then we find these guys and we get them to partner with us.
Yeah, if I can, I think from our investors' perspective, again, this is an important point to understand. So the OrbVest's partners on the ground need to be significant enough players that the banks will loan their money on these projects. You know, it's not a startup with no reputation, no not bank sheet. Sorry, Justin, what's the word you used? My brain has gone dead. But the balance sheet, geez, I can't believe it's been one of those days. No balance sheet, but that's what the partners, apart from their skills and experience, they need to be able to bring that to show that they are real established players in that particular area. And so, yeah, if I can just make sure we're all talking the same language. So you will find a partner on the ground. There's a great opportunity, a great deal, and let's say it's going to be 60% of that is going to come from a loan from a bank. It is that partner on the ground that actually needs to be able to demonstrate that they're able to get that loan and sign on behalf of it, so that they're actually putting themselves very firmly into this. Their reputations, more than just their reputations, are actually putting their signatures on the documents.
100%, Lyndon. You could be doing this presentation yourself. Excellent. Thank you. All right, let's move on. So a couple of fundamentals of property. You guys are all property guys. You understand what's important with property. Two things. If you're buying a property, make sure you're buying it in an area that's growing, and that is growing in population and growing in GDP. Because if you're growing in population and GDP, there's a high probability your building will, even if you make a mistake and buy a bad building, it will go up in value. So very important. You will notice as we zone down to the areas that we do business, Texas, Georgia, you'll know this little spot here. We did one recently just outside New York in the Manalapan area, which is New Jersey, and then finally Florida, where we are looking to do something that's a conversation for another day. But let's have a look at the two areas that we absolutely love. And guys, if you haven't been to the US, we do encourage it. One of the things that we still do is we take people to the buildings to have a look for themselves. And Texas is absolutely amazing how it's growing. You just feel the atmosphere when you go there. It is absolutely cooking. Again, this is something that I'm going to fly through. You've heard all of this before, but if you really want to be entertained, listen to one of Henny's presentations about the disruption that's happening in the medical space. It is happening fast, and it's going to change the way that medical is delivered. He talks about the change from delivering sick care as it is at the moment. When you're sick, you go to a hospital and they try and stitch you up and send you out again. The future, and the future is already here. So when I talk about the future, it's the change that we're experiencing at the moment, is that you don't go to the hospital, you actually get identified that you've got a problem before the problem manifests itself, and they can take remedial action and fix the problem before it manifests. And this is what we are experiencing. In fact, Henny is on a 6-week trip around the States at the moment, starting off with a medical disruption seminar at Singular University and moving on to a bunch of different biotech companies to get a first-hand view of what's happening and the trends. As I say,
so Justin, I mean, on that note, you know, we spend a lot of time, I think both of us, plus many of the people on this call, we spend a lot of time looking at the future and trying to predict trends. You know, as an investor, you need to be able to do that. And I was fascinated by a blog I listened to about 3 or 4 days ago, that there are actually now apps that you can download onto your phones, and they run in the background and they listen to your voice when you're having phone conversations, because many of the key diseases have impacts on your voice. In other words, it'll either slow down or it won't be as sharp. And just by running this app in the background, it can predict you, often with a few years advanced warning, that there's something happening to you that you otherwise would not have been able to know. So this idea of the medical space really changing quickly, that there's huge amounts that you'll catch a lot earlier, and then, as you've said, it's about being healthcare, not sick care. We're seeing that across the world in some really fascinating technology.
Yeah, really interesting, guys. I'd love to spend more time on this. I think the key fundamental is, we talked a little bit about medical on your question earlier, Lyndon, but it is a balloon that is happening. And the key thing in the US is that the baby boomers are getting older. The stat is that if you're over 65 years old, you go to the doctor 5 times more than if you're less than 65 years old. And you know, do the math on that. Add to that the fact that the population is aging as these boomers get older. And then you've got to add to that the final thing, that we are now extending these boomers' lives, and the fact that the boomers also are very rich because they've lived through the good times. So that's why there is this acceleration of spend on medical, which is still got 20 years to run at least. Right, now let's try and excite you on the deals, or share with you why we're so excited about these deals. So Med24, what is it? This is a bunch of buildings that we know that many of you older Wealth Migrate people that are on the webinar tonight know. You might have even visited these buildings, and I'll tell you the story. So we had Med 1 and 2. We offered them for sale. They were at the end of their 5-year period. And we had a very good offer from an institutional investor, a fund, and they came along and they looked to buy both Med 1 and 2, all of the buildings in one portfolio. Very important to sell a portfolio, because small investors don't pay the premium, big investors pay the premium, but they want to get an investment at least of 20 to 100 million, otherwise they don't get out of bed. So we offered these two together, and in the final days of the transaction, they negotiated to reduce the price on specifically three of the key buildings, or 4 of the key buildings. 3 of them are tenanted by the government. Now, that sounds pretty crazy, but bear in mind that at that stage, the government, or in this case, the Veterans Association, would only sign a lease of a year. And by the time the deal got to close, that year was nearly done. So they said, well, fine, these buildings don't have the NOI or the income, so we want to discount them. And our answer was, fine, we'll pull them out of the deal. So we pulled these 4 buildings out of the Med 1 deal, and now we sit with these 4 buildings with short leases. We have approached the Veterans Association. The Veterans Association have changed their policy. They have agreed to enter into a 5-year lease. We are trying to negotiate to extend that to 10 years. But at the moment, as far as our disclosure is concerned, it is 5 years. Immediately, that adds significant value to these buildings. A government lease for 5 years is extremely valuable. So what do we do? They're little buildings. To sell them on their own, we probably won't get a premium, and there is a delay. Because it's US government, there's a long delay to get this stuff over the road. We think it could take 6 months to get the leases properly extended. At the moment, they have been renewed for a year, but that's not what we're looking for. So we need to actually house them somewhere, and what we decided to do is to approach the investors and say, let's take them and add them to another portfolio, which is Med3, which had some vacancy in it, and it had 2 buildings in it. And if we put the lot together, it makes a fantastic portfolio of 6 buildings. And we have agreement finally from by far the excess of the investors. It was 88%. And so we are now able to go ahead with this. Now, there are a couple of other benefits. By creating one portfolio, instead of having a few different senior debt loans, we were able to consolidate the loans. First thing. Second thing, because we now have a better reputation and a longer track record with the banks, we have managed to reduce, we've been negotiating with Capital One, we've reduced our interest rate from over 5% down to, and it looks like we'll close at around 4.3%. So there's a significant benefit in the restructuring. What do we need? We need $4.6 million in equity, and we have to close before December. So you'll notice that these time periods are getting much shorter for us, and I'll talk about that perhaps a little bit later. What is the IRR? And I'll give you a little bit more information in the actual sheet. We are under pressure for time, so I'm going to push on a little bit. I think the most important thing to remember here, guys, is these are all tenants that we know, that Migrate know, that we know, that have been great at generating cash. Where are they situated? Well, you'll see they're spotted a little bit around Atlanta. I think the important thing to note is, remember, this CON, or Certificate of Need, means that you do have medical centers that are spread around, because they do want to spread the service, the servicing of medical around the place, but all around in key areas around Atlanta. And I'm not going to spend too much time on Atlanta. Atlanta for us is absolutely the plum. We have a lot of effort in expanding our network in Atlanta. 2 of our recent deals, if you look at the expansion from Sandy Springs up to effectively Lake Lanier, which is the equivalent of the Joburg. If you're in South Africa, you'll be familiar with the Joburg to Pretoria corridor. Everything is building up along that road. There's a massive amount of growth. And we have 2 other campuses, one in Sandy Springs and one in Milton, that we are developing out, and you'll hear a little bit more about those later on down the road. This is what these buildings look like. This particular one is a VA building, or a Veterans Association building. Again, it's Ferry. I think this one has got a dentist that has spent recently about $1.5 million in refurbing the inside of this building, so it's really stunning inside. And this is a group of buildings. There is a VA building here, and there's one that is vacant, which we expect to fill. And when I get to the rent roll, you'll see we expect to fill the vacant spaces by the time this deal closes. This is the most beautiful of the lot, the Swan building. This makes up one of the buildings in Med3, and I think that's the one that the surgical center is going into. So we have already added value in that we've signed a lease for a surgical center that has a certificate of need that is locked to the building, and so that is, a great win for those investors. So rationale for the project, I think we've covered this as we've moved through the individual buildings. I talked about the VA leases and the value of those leases once they are taken to 5 years. I talked about the portfolio, which we will take from 12.9 million to 23 million, which now gets to the point where, give it a little bit of escalation, it gets to the 25, which is the kind of magic number for the institutions. And that's all we're effectively aiming at doing.
So Justin, maybe I can just jump in here. And in terms of you talk about the institution. So for some of our new investors who might not have been through the complete cycle of a deal, why is that important in terms of when you know at the exit you're going to have the potential to sell to institutions, not just other smaller investors?
No, absolutely. I think the institutional investors, guys, are flush with money at the moment, and they need to find opportunities. They've got to place that money, and so if they find a good portfolio or a good opportunity to invest, they will absolutely pay a premium to get into that product. When you're dealing with the smaller investors, you end up having a long negotiation. You have a difficult period before you close, because there's always renegotiation before you close. It just gets extremely messy. So the big thing is that our mandate is to sell after 5 years. At that point, if you are in a position to approach the REITs and the funds, and they will take down your building, you have a guy that can write the check, and you know that they will behave in a way that is effectively responsible, and they're not going to try and renegotiate on the 11th hour. So very important that we get the right institution to buy at the end of the day.
So once again, if I can just step back here for our new investors. So what this means is, to say what Justin said again, but in 10 words, by the time the deal closes, you'll get paid more, and you're far more likely for the deal to happen smoother because you're dealing with a big player. So it's a really great strategy that OrbVest has here in terms of targeting opportunities where they're thinking all the way through to the end. They're really thinking about, in the 5 years' time, how do we make the most amount of money possible on our exit? And if you can pitch the opportunity that you have to an institutional buyer, a big company that's looking for a big opportunity, the chances are you'll get a better price and get out of there quicker.
Thanks, Lyndon. One of the questions that we have that I'm going to answer in advance is, sure, but how did we get to the value for the 4 buildings? And how do we know that that's a fair price? Because are you keeping the existing investors happy, or are you keeping the investors that buy in happy? So what we said is, the investment committee said, fine, go and find valuations, and they must be completely independent, and they must give us the exact selling price. We did that. Ultimately, CBRE has given us a valuation of 9.335. We did our math based on 9.5, which means there's a little bit of value add there for the new investors coming in. And we are very happy with that valuation. We think it is on the nail. The other thing that's important, and maybe I can talk a little bit about cap, Lyndon, if you don't mind. So what is a capitalization rate or cap rate? How you value commercial building, very different from residential, is you take the net operating income, or in simple words, the rent less the expenses, and you multiply it by the rate that investors will pay for a building in that particular area at that particular time. And it's quite a science, obviously. It is, it's projected over a period of time. And what we've done is we've taken all the information from Revista, from the Federal Reserve, from WSJ, and we've plotted it. Our Billy Olofs, our analyst, has plotted it. And we get to around about 6.25 at the exit point of this investment. You'll see the end of the little blue dot. For the purpose of this, we've said 6.6 is our exit price for the purpose of our math. That means, and remember that the lower the cap rate, the higher the price. So it works the other way around to what you would anticipate. I hope that explains it nicely. Also look at it that if you accelerate from the 3-year period, you make it a 2-year period, it's anticipated that the market will even be more buoyant at that point, and so the cap rate could even be lower at that point if we can accelerate it.
Justin, great. And just a note to all our investors, please, if you have any questions, please do drop it in the question box. We are monitoring it. As soon as any question comes through that we can answer for you and post adjust, and we will make sure that happens. So if you do have questions, please do use your question box, and let's get them answered for you live tonight.
Excellent. And now we move on to the crux of the matter. This is the lease up, the tenant schedule. And you'll notice these are the beautiful ones, the ones that say United States of America, because you know that your check will come through. I say that we did actually have a delay when the government shut down, when Trump refused to approve the budget, but you know, that's always only temporary with the government, so you know, that caught up pretty quickly. But United States of America is just a beautiful lessee to have. The vacant spaces, as I say, we have already signed a surgical center with a certificate of need, and that is already going in. So we've already plugged a couple of those holes. And if you look at the red bit there, what does the red bit mean? It means that's what you've got to be careful of, because that is the leases that are now either vacant or they've expired. And we are well on our way to killing this. You must always look at the red bit as an opportunity, because the value of the building, remember, cap rate times NOI. If your NOI is lower, then the cap rate is effectively lower. The price that you buy in is effectively going to be improved by us tenanting up this building and adding more NOI to the overall group. So that's really all I want to talk about on this particular slide. So purchase price of the individual buildings, as I said, the valuation was 9325, and there are a bunch of expenses, and you will see that Medical 3 equity and outstanding debt. So that is effectively the value of the Medical 3 portfolio, the two buildings there, to bring us to a total investment of 24 million. So obviously we don't buy out the Medical 3 investors, they stay in, so we don't have to raise that money, but we will restructure the debt. Amount financed is 15 odd million, and you'll notice our loan to value is 63.26%. Super important for new investors, always watch out for this loan to value. Remember that the banks in the US are very aggressive, they'll give you 80% loan to value, but what happens is if there is a recession, and this is very important to remember, the bank will come along and relook at the value of the building, and if they say that the building has gone from 20 million to 15 million, they'll say, guys, you are no longer within your debt, your loan to value ratio, we want to have a capital call. And then that particular operator has to come back to you as an investor and say, we need you to put in more money because the bank has reduced our value. So very important, if you want to be recession resistant, have a lower loan to value. And that's, again, one of the things that we do that makes us conservative. So that's it, equity available, 4.48 million. Tenant risks, obviously, we know the tenants, these are long-term leases that we have and we are putting in place. And we have a reserve, if you remember that previous slide, for rollover to carry us through if it takes us longer to fill those vacancies, or if we get a new vacancy because somebody defaults. On the interest rate risk, not only have we reduced it from the current deal, which is over 5, and brought it down to over 4, but we will fix at that price because we're anticipating a recession. And if there's a recession, we don't want to be caught with escalating interest rates again. Valuation risk, the other big risk is the cap rate. And I think that if you remember what I said about medical and the increased amount of demand for medical relative to the supply, you will understand that our mitigating point is that there is an increasing amount of demand, and you know, we're fairly confident that any vacancy we will fill in the future, even when it does get a little bit tight. So at the moment, the planned holding period is 2 to 3 years. And I think that what you do need to remember here is that at 3 years, if we only get a 5-year lease with the VA, for example, you're selling the building with a 2-year lease still to run. And we would like to sell it at the absolute plum. And the intention, and this is not in our current prospectus, guys, but it is something that we are absolutely going to work on, and that's to accelerate it from 3 years to 2 years. So this is, what I would like to call a flip. It's a great one if you want to put your money in and see if we can accelerate it to 2 years, which will really increase your IRR, or your return over the 2 years. But I'll show you what that looks like. So if you were to put in 10 grand here, you'll notice that that you would get 3 dividends over the years. Year 1, you'd get $863. Year 2, $839. Year 3, $885. Bear in mind, these are our best estimates with allowing for vacancy, and that's why it actually drops off in year 2, because we assume some vacancy there. And yeah, again, this is probably not as relevant to your investors. Those are for investors that go in via an LLC via the States, which is not really important. This is the sort of return we're talking about here. And I just want to show you the difference. This was when we did our initial sums on 9.5 million, but the new valuation at 9.3 improves it a little bit. So look at that number at the bottom, 8.7, 8.5, 8.9 cash on cash, and then 12.5 RR on exit at 3 years. But what happens if we push the sale to 2 years? And this is where it gets super exciting. This is what we would like to do. We'd like to push it to 2 years and get it to 17.26 RR. So you would get cash on cash, not for 3 years, you get it for 2 years, but you'd make a nice big lump sum at the end. So again, as far as the subscription agreement is concerned, it is treated as a 3-year project, but we would like to accelerate it to 2 years if we possibly can. It is already live. Lennon, I assume you can confirm that it is live on your site. I think it is. I think that what happened to us in our previous deal is we ended up with a lot of people trying to move right at the end, and we actually upset a lot of investors. And to try and mitigate that, we are now saying that it's a first come, first serve process. So please, if you are interested in this deal, I suggest that you have the conversation with Lyndon and his team, and you go online and do the thing as quickly as you can. What happens is it does tend to fill up very much at the last minute. So 1 minute it's fine, and then suddenly everyone moves their money, and it happens at the last minute. Our closing time we anticipate is the 22nd of November. So you can see that these things are really limited opportunities. Should we?
So just on that note, if I can jump in quickly, 2 things. Firstly, it has been live now for about a week and a half on the platform. We have had a lot of investors already putting money into this opportunity. I think they're aware of the fact that we have there are 2 factors here. Firstly, timelines, but secondly, I think this deal has a lot of interest within the community, and we want to make sure that the investors themselves want to make sure they get into it before, as you said, it closes. So we certainly do encourage all the investors, just like Justin said, do go onto the platform, complete your investment, and make sure you don't miss out on that one if you want it. There's a question from Francis. Francis, it's a question about how the money flows in the structuring. I think what I'm going to do is I'm going to take that at the end, because it's the same answer for the medical 26, and I really want to give Justin an opportunity while we have him to go through this deal quickly, and then I will jump on and answer that question. If I don't get a chance to answer it before you have to leave, we'll make sure we reach out to you personally and give you an answer, but I'm pretty sure that's a question that everyone here would like to know, for those who don't have it at the moment. So absolutely, Justin, let's race through medical 26, because there are some questions coming through, more general, and then we can start answering the questions.
Fantastic. So guys, I must tell you a little story about this one. This is a new sponsor. It is a massive company. It's called Lincoln Harris, and I suggest that if you are interested, go and have a look at lincolnharrishealthcare.com. We have approached them over time. It was like, going to the big brother and saying, please, we'd love to do a deal with you. Have you got any deals for us? And they kind of, they brushed us off a little bit. Then what happened is we found this particular building off market, and there was a lot of competition for it. And they literally said, it's closing. Whoever brings the hard money in first has got the deal, and we managed to win it. So we won it, and we beat out a whole bunch of other people like Lincoln Harris. I think, we were kind of the unknown entity, and when we closed on it super quickly, that we caught them a little bit by unawares. So they did come back to us and they said, listen, we really need to talk. We can't believe you bought this building right out from under our noses. And we said, well, that's fine. We were going to bring in one of our existing partners, but we would really like to do this thing with you. And they have now agreed. And it is really, really fantastic. I mean, these guys have a massive portfolio of medical buildings throughout the States. And they are big operators. They've got a huge staff. And just to talk about the due diligence, for example, this is a big building, got to be very careful of operating costs. They had a team that they immediately set out to do a complete due diligence of everything, the HVAC, the lifts, the windows, the glazing, and it was just an incredible experience suddenly dealing with a team that has 30 people in the office around the corner that can attack this thing and help us with the due diligence. So what we're super excited about is that it's a fantastic building. It is a very clean opportunity. There's not a lot of complicated stuff, and it is a great partner to be involved in. And as you know, early on, partnership is everything. It's the third leg of the table. So that's what it looks like. There's two chunks of equity. One is the retail bit, which is just over $4 million. And then we have the cornerstone investors, $500,000 pops to make up 2.5 of them to make up 2.5 million. Lovely big building, 200,000 square foot of space. And although it was built in 1981, it has been renovated. The period for this will be 5 years. And it is, I'm going to show you a little bit about the location because it's really worth talking about. So I mentioned earlier how Texas is just something that's well worth a visit. If you haven't been there, just to give you an idea, these two cities, Fort Worth and Dallas, have a GDP larger than France. That really puts it into perspective. It is just a massive economy. And as I will show you just now, there is this is where Two Forest Plaza is, our building, and in fact you can see it better on the next thing. So unfortunately, it only has the 4th busiest airport in the world, and there it is, just down the drag from our building. This is the 9th largest city in the US. It's part of the Texaplex, which is this area that is growing absolutely phenomenally. It is super landlord friendly. There are no state taxes, which is a benefit to us as well. And the population is growing. As they say, by 2040, they anticipate it will be at 10 million people. That's a 47% growth from now. Absolutely ticks all the boxes. This shows you Medical City, which was the big hospital in the region. Medical City expanded to that block there, then it expanded to here, then it ran out of space. It jumped over the 75 to Forest Park Medical Center. Then it came back and it took over this building over here, which by coincidence just happens to be operated by Lincoln Harris and shares the parking lot. And then finally, we've taken this one right in the middle of the core of what they all wanted. So it's absolutely magnificent. This 75, just to give you an idea, not like California and other municipalities that are battling from a financial point of view. This particular municipality is so cash flush, they've just spent $10 billion on the 75 highway. So that comes right past, and it's like an eight lane on each side. It's a magnificent piece of engineering. And it also links with the other major freeway, I forget what it's called, that links through to the airport. So very key area. And that's it. Look inside the building. I'll show you this. Absolutely first class A grade internal finishes. And if you take a look at the picture on the right, I just want you to take a note of that, because This is one of the questions that we get asked a lot. And the question is, number one, there is quite a lot of non-medical in the building at the moment. Number two, the biggest tenant is New York Life, which is a blue chip big insurance company. They occupy 42,000 square feet, which is massive, and the lease is up, and that's why there's the big red bit. So normally this would be a concern. We have engaged with them. They say absolutely they want to renew. They've been in the building for 16 years. On the basis of the handshake that we will renew, they have gone ahead with the renovation and spent, I believe it's not 1 million plus, it's $1.5 million on renovating their premises, which is at the top of the building. So we will absolutely keep New York Life there. It would be crazy to kick them out. We'll put them on a long lease. We will push their rental up closer to the market, which is 25 from where they are at the moment. And we don't mind having an office tenant of that nature on a long lease. So the second one is this crowd called LDA Management, and they, as you can see, are paying 23 Rand a square meter. This has already been renegotiated right at the closing, and what we have agreed to do is we're not paying a premium for that tenant. We have agreed to pay the tenant installation cost instead of paying a premium on the building. So just bear in mind that we have allowed those two non-medical tenants to stay, and that would make up about 40% of the building. The other 20% that is either vacant or tenants that are moving out, we are absolutely replacing with medical tenants, so that at 60% it will be regarded as a medical building. So that's the tenant role. As I say, the red is an opportunity, and you can see that there's already a lot of long leases there, and we're going to push that out to make it super attractive. What does this building look like? Capital structure is just under 30 million. You can see that these 5 million of the capital structure is a reserve. What that means is we don't actually take this money, but while everything is rosy and the world is cash flush, we borrow the money, but we leave it effectively as an excess bond. So that's $5 million that we don't take. So of this capital stack, 38 million, 5 million is just a reserve. In fact, so is some of the other stuff. The interest reserve is also there in case the tenant leaves, and some of the other incidentals are left in the loan. Once again, look at these key things here: loan to value 54.95, and a debt coverage ratio. In other words, how much you would be able to cover your debt in the event that you had defaults, 3.66. Over 3 is just fantastic. It means that there's a very, very low chance that you're going to ever get into a tough situation with this building. One of the ways that we achieve this is a thing called a ground lease. If you're in South Africa, ground leases don't sound very good. In the US, they're actually considered to be a benefit in your structure. So what is a ground lease? Effectively, you're selling the land and you're leasing the building back from the landowner. The lease is a 99-year lease, and we are now always negotiating in a first right of refusal, or an option actually, to buy back that ground lease in the event that we want to. And I want you to think about it this way. Would you prefer to take capital at 16% IRR, which is very expensive, or would you prefer to take a ground lease at 4% interest? Ground lease is really cheap money, and it helps us to pump up the returns, and that's what makes these sort of buildings very exciting. There is another thing that is important on the ground lease, and that is that if there is ever a major recession and the building gets into trouble, the banks are very aggressive in the US when it comes to commercial buildings. And instead of doing a capital call and scraping back any money you've got in your bank account and effectively taking control of the building, they now have a creditor which sits above them, which is the leaseholder. And after the financial crisis in 97, 98, the learning was that Ground lease buildings didn't get touched by the lender, and non-ground lease buildings did get touched. So fascinating learning there. I've talked about these already in my general commentary, so I'm going to blow past those quickly. Holding period will be 5 years, and we will add value obviously by converting the 20% of vacant and expiring leases to medical, and that's the way that we will add value to the building. Just on the forecasts, you'll see over the years, year 1, 6.5, year 2, and 9.1, year 3. We have budgeted in that we would have some vacancy here, but in fact, we hope to flatten that out. Also in year 3, our senior debt, the loan from the bank, does require some capital contribution. So it starts to kick in around about here. We honestly work to make sure that we flatten this out, but for the purposes of being conservative, we make sure that that's taken into consideration. Again, the net amount in the US, excluding tax, is 16% IRR, and after tax 13.9% IRR. So again, I think this is live on the platform, and I must say it is accelerating very fast. We have had interest from some of the institutional investors, and that means that it can quickly vanish. So I really would urge you, get moving if you are interested. We absolutely have to close this deal by the 4th of December, so we expect to close the funding round on the 26th of November. Sorry, 4th of December we will close. 26th of November will be the end of the funding. So it's going to be a fairly tight timeline. Get in quick if you are interested, and we are to answer your questions. That's it. That's all from me, Lyndon.
Lyndon, we can't hear you.
Are there any questions that you would like to?
Thanks, Lee. It helps if I unmute, doesn't it? So let me just share my screen quickly with you. There have been some questions that have come through, but let me just quickly share my screen. Lee, can you just confirm that you can see the Wealth Migrate platform?
Yes, I can.
Brilliant. So Justin is 100% right. Both of these are live on our platform. For our investors, please do go onto the platform, click on the deal card. All the information you need is right here. The information Justin's just gone through, there are both the brochures and the memorandums, which give you a lot more detail if you'd like to go through the information Justin has provided. There's the summaries. It explains to you who is OrbVest as well as their due diligence process. So the investment process, I'm sure many of you know it. It's very simple. Click on invest in this deal, and it will take you through the opportunity that allows you to do your investment. So it is there. It is live. As Justin has said, we are getting a lot of interest on our platform, and Justin and his team are raising a lot of money out of the US and institutions. So we certainly do recommend that if you want to be part of either of these two, that you do it soon. Lee, I see there are quite a few questions coming in. So maybe if you want to send them our way, and let's see what we can do to answer them.
Yep, absolutely. So we've got one from Costa that says, can you please explain again for medical 24 and 26, what is the capital call and how you protect 24 and 26 against the bank revalues of property?
Okay, Costa, yeah, so you know, it doesn't happen all the time, but let's assume that there is a major recession. What would happen is the bank would look at your let's say the cap rate in the area, and they would say, well, hold on a second, we've revalued this building from, let's say, 20 million down to 15 million. So therefore, the value goes down, and the amount of equity that you have in the building now becomes too little to cover the ratio that the bank sets, which is normally, as I say, 80% loan to 20% equity. So you know that's not an ideal situation. So the way that we mitigate that is we don't take an 80% loan at all. We take a 50 to 60% loan. So we have a lot more equity in the property than they require. So the chances of, if there is a revaluation, it doesn't affect us. There should be no capital call.
Justin, what's that magic number from your guys' experience? What's the point at which you think, and just as a piece of education for all our investors, what's that loan to value point where you think you're at significant risk?
So I think there is actually an exact number, and I can't remember it because we look at so many deals at the moment, but it's around about 65%. So we try and stay below 65%. Lyndon, you might actually remember that number better than I do. But 65% I think is the number that we don't want to exceed.
Yep, great. Lee, are there any other questions that have come through about the deals tonight?
We've got Francis' deal about the money flow. Her question around
yes.
the money flow.
Brilliant. Thank you for reminding me. So, Francis, it is something that has been one of the changes over the last years since our split. Wealth Migrate aggregates all our investors, all the Wealth Migrate investors, into a SPV, and then that SPV invests directly into the OrbVest's deals. Our structure, we're very excited. We are testing the new wallet system at the moment, the new transactional accounts. We're also changing our language. So from now on, you'll start hearing us speaking more about transactional accounts than wallets. And the reason we're doing that is because the transactional account is really what we're offering. It's a way where from within the platform, you are able to receive dividends from one deal and immediately decide either to withdraw it or transact into another deal. And so we're very excited. We're testing that. It's about 2 weeks away. But all the financial money flows, the investment, all the returns will come back into your wallet, and then from there you can invest it straight into any deal on the Wealth Migrate platform. So that is how the money flows are going to work. We literally have about a 2-week period before 2 to 3 weeks. My head of IT will probably shoot me for giving you a final prediction, like 2 weeks. So let me hedge my bets by saying 2 to 3 weeks. But in the interim, the financial flows are still moving through escrow accounts. In other words, to invest in this, you will still need to deposit your money into an escrow account, which is held in the US. And then in about 2 to 3 weeks' time, we'll be switching completely over to a transactional account system, and we won't be using escrow accounts anymore. So the money will not return into any of your private bank accounts. They'll go into the transactional account until such time as you want to withdraw it into your bank account. That's completely in your control. At no time, once the transactional accounts are in place, at no time does Wealth Migrate ever have access to or control the money. That's the great thing about transactional accounts, is that you are the only one who can move money in and out of your wallets. No one else can, including us. We can't access it on the back end. It's held by a third-party service provider. So we're very excited about our new wallets, our new transactional accounts. We have a world-class service provider who operates under the European Union licensing arrangements, which are some of the strictest regulated environments in terms of holding clients' money, and they're a very professional bunch with a very good tech stack that we're integrating into the platform. So Lee, I hope that answers Francis's question around that one. Are there any other questions that have come through for us? I know we're probably running a little bit late, so thank you to all of those of you who have stayed on with us. We appreciate it. I think it's a great indication of the amount of interest that these two deals have generated within the ecosystem. But are there any other questions?
I think you answered Francis's question and Karina's all in one, so that's great. Karina wanted to know whether they do their investment through Wealth Migrate or through OrbVest's. So I think we've answered those. I'm just checking here.
I see, Lee, if I can, I see there's a question now about how we're migrating across to the new wallet systems, and we will be providing a huge amount of information and updates to that question in about 2 to 3 weeks' time once we have completed the migration. We will be making sure we're going out to all our investors and really educating them on the new system and how it works and how the new wallet, the transfer to the new wallet system will be working. I think my suggestion is on those questions, we have noted, I think there are 3 or 4 people who have asked that question, so we will make note of you individually and we will contact you directly. But there will be a very big education piece. The great thing is that it's going to be extremely simple in terms of the new transactional account system. It really is an intuitive inbuilt system that we're moving to. So we will do a huge education drive around that in the next few weeks.
That's great. And those were all the questions that we got. If anyone else has something, please just pop it into the box. You've got about 2 minutes to go.
Justin, I think your deal explanations have absolutely nailed it. We aren't getting any of the normal requests for information we do get around deals specific, and I think it's because the information you provided was extremely thorough. So nailed it on that one. I guess the question that many investors are sitting with is now which one? And they've got 2 options on the table. And, if you had to give them any thoughts on that, would you say one or the other, or would you say let's do them both?
I'm very clear. I don't have to think about that answer. And you mentioned it earlier on, diversification, guys. No deal is better than the other one. They are all good. And the point is that should you choose one over the other, I would not do that. And I don't do that personally. I put the same amount into every one. I don't look at the exchange rate. I do look at it, but obviously I have to look at it. But I don't really look at the IRR. I don't take that as a guideline. I say, is this a good building? And then I just do the same amount into every single building, ka-ching, ka-ching, ka-ching. And that way, ultimately, you end up with a good, solid, diversified portfolio. And that's what you should be looking for. Remember, and if we were living in the old world and we invested in REITs or in funds, you would get that smoothing effect because there are lots of buildings in that fund and you don't actually know what's going on behind the skirt with the ones that are doing well and bad. It all gets lumped together. Here, create the same security by having investments in the different deals so that you get a spread of risk.
Great, Justin. I guess the only thing I can add about the 2 differences for investors, just to bear in mind, is they do have different time projections. So if you within your own investment strategy, your own investment timeline, the one is 3 years, maybe coming down to 2. The other one's a 5-year, and that might influence a particular investor's decision. But otherwise, the returns are very similar. They're both great opportunities, as Justin has said, and diversification is certainly my personal strategy as well. Justin, we have got a last-minute question here from Aju. He says, hi there are significant vacancies. Is there currently interest from potential tenants?
Aju, yes. We see a vacancy as our opportunity to add value. I think there's 2 very important points here. One is that your partner matters a lot. And with coming online with our new partner, Lincoln Harris, we will nail those vacancies in a very short period of time. Remember, there's the 2 different projects will be handled differently. The other project, we already have secured most of those tenants. So we have the surgery center moving in. So a big chunk of that vacancy has already been covered. So yeah, that's the value. And maybe, Lyndon, what we haven't done is we haven't explained for your new guys how the property partner actually makes money. And I think that maybe is a bit remiss. But that will probably help you to understand our incentive. Our incentive is not in the beginning. In the beginning, we build in a fee that we earn out of the project in the beginning, but most of that goes to our operating costs, the due diligence team, the flying people to and fro from the States, the transactional costs, etc., etc. So we don't make much money in the beginning. During the course of the property's 5-year period, we earn a very small, it's between $2,000 and $3,000 to give you the exact amount per building. So it's not it's purely covers the cost of our reports and our analysts, etc. And then at the end, that's where the prize is. So where we are aligned at the end is we want to add as much value to that building as possible. We want to pump up those returns at the end so we can sell that building at a premium, and then we share the profits. Investors get half, and us and the partner shares the other half. So that, I think, helps you with the understanding the motivation to get that up. The other way that we make money is we have a thing called a hurdle. So at 7% return, cash on cash, that you get free of charge. If we make more than 7%, if we get a return of 9%, then that additional 2% we take, and we split that 2% with you on the same ratio. So 50% goes to us and the partner, and 50% to you. But those returns that you see there, that's already baked in there. So we've already allowed for our additional split there. So our motivation is purely on performance. Our sponsor's motivation is purely on performance. So we absolutely do not want that thing to sit empty.
Justin, there was a follow-up question from Ajay at the beginning of his question. Almost immediately afterwards, he asked, does the purchase price factor in the vacancies? So in other words, if your net income is lower and you're buying on a cap rate, has the fact that there might be some vacancies already enabled you to buy the building at a cheaper, a discounted price?
We are talking about 6 buildings on the one side and 1 building on the other side. So I'm going to have to say that it's probably average. It's probably we have got a bit of a discount because of the vacancy, because of the lower NOI. But if I'm talking about across the board, I would say it's probably average.
Okay. I think that was it.
You definitely don't pay for vacancy.
No, absolutely. Lee, can you confirm, was that our last question?
That was our last question, guys. Thank you very much for a fabulous presentation, Justin. Very valuable to have you on here, and a very detailed explanation on your 2 opportunities. Thank you.
Thank you very much, Lee. Thanks, Lyndon, and thanks to all of you for giving up your evening.
Absolutely, guys. I think you've heard that these deals are likely to close quickly, so please do go onto the Wealth Migrate platform, wealthmigrate.com. Both deals are there. They're available. Make sure that you invest in this deal. The only thing I would say from our side is that if you are KYC'd already, so in other words, if you've already been verified as an investor, and you might be listening on this webinar for the first time and you're a small investor, do bear in mind that next Wednesday is Wealth Wednesday, where we do drop the minimum amount. So you're welcome to take advantage of that, but please note you have to be KYC verified before you can participate in the Wealth Wednesday minimums, which are lower. However, I wouldn't wait for that. If you're not going to invest at those low levels, I'd strongly suggest you get in quickly, because these deals will close out pretty quickly. And with that, I'd like to say good night to everyone. Thank you. It's been a privilege to have you on here. Justin, thank you very much. As usual, OrbVest's always delivers really great explanations for their really great deals, and it's great to have you guys as partners. And so with that, thank you, everyone, and have a good night.